This is John Crypto. Get ready because the numbers you're about to hear are more than just shocking. They're a warning shot across the global financial system. In the last 24 hours, the crypto market saw $756 million in liquidations explode across BTC and ETH. Longs in BTC lost $147 million, and longs in ETH lost $171 million. And here's the kicker. ETH dropped almost 10% in just one day to 2,028 ETH, while BTC dropped below $77,000 from its peak of $126,000, losing $800 billion in market cap. Now put the pieces together. This wasn't a slow leak. The crash happened during the Asia-US trading overlap, which is known for having low liquidity. Retail traders were easy targets, and leveraged longs were margin called and wiped out while the smart money circled like predators in the dark. You've been told a lie. Headlines screamed markets stabilize after dip or volatility normal. They make it seem like everything is fine, but they don't show the destruction that is hidden in derivatives, ETFs, and OTC flows. The news wants you to believe that this is just another small problem. But what's the truth? This was planned chaos, a carefully timed massacre that caused panic in stores and helped institutions build up their assets. The numbers are clear. More than 200,000 accounts were deleted in one day. Like a chain of dominoes, margin calls fell one after the other. Retail leveraged positions fell first, leaving ETH and BTC flooded with forced liquidations. The whales, on the other hand, moved quietly. Asian OTC buyers, BlackRock and JP Morgan weren't scared. They were eating. Since December 2025, 120,000 ETH have been moved to cold wallets, and retail investors have thrown 150,000 ETH into the storm. Here's where it gets interesting. Volume analysis shows that open interest shot up hours before the cascade, which is a clear sign that smart money got ready to take advantage of retail despair. ETH, which made up 44% of all liquidations, shows just how weak the retail crowd was. And because the amount of money available dropped from $47 billion to $40 billion, even small price changes caused big sell-offs. What about retail traders? Caught. Longs lost everything when ETH hit $2,400 and BTC hit $77,000. Margin calls piled up, panic spread, and fear became a self-fulfilling prophecy. In the meantime, whales danced through the chaos, carefully taking in the destruction without raising the market yet. They were the unseen architects of the crash, building positions in silence while the small fish floundered. Now here's the psychological twist. The Michael Saylor effect. Even well-known stacks like Strategy's BTC holdings went underwater for a short time. Fear spread like wildfire on social media, and retail panic grew. Every tweet, news alert, and market crash headline made people give up, which put more coins in the hands of whales. The smart part, institutional buyers didn't have to do anything. They let the chaos do the work for them. And don't think this was a coincidence. This was a perfect storm of political events, comments from the Federal Reserve, and a lack of liquidity. Tensions between the US and Iran, Kevin Warsh's nomination to the Fed, and the overlap between Asia and the US all made it the perfect time for a liquidation cascade. It was easy to see that people would panic in stores, and the smart money took advantage of it with perfect timing. Watch the next layer. Smart money isn't just buying things that are going down, they're also planning when they go down. The $756 million wipeout isn't a mistake, it's a sign of a bigger problem. Exchanges are losing money, liquidity is drying up, and retail is still the scapegoat. Mega whales are quietly piling up ETH and BTC in preparation for the next phase. This is causing a structural imbalance that could blow up at any time. You think this $756 million drop is just a glitch in the price? Think again. This is a market that has been perfectly manipulated, with retail traders being the ones who lose and whales and institutions being the ones who win. Every forced liquidation, every margin call, and every retail sell-off makes their accumulation fire burn hotter. And here's the cliffhanger. Wait until part 2. The exchanges are losing money, and the real blood isn't just on the price charts. It's in the order books, in the vaults, and in every trading account that was emptied for profit. The next chapter tells you exactly how the supply was drained and how smart money got ready while retail investors screamed into the void. While part 1 showed the destruction, the real story is told in balance sheets and cold wallets. The exchanges are like a crime scene. In just 1 week, BTC and ETH balances fell to their lowest levels in months. 50,000 BTC and 200,000 ETH disappeared from active trading accounts. Thin order books turned every forced liquidation into a precision massacre. Retail longs didn't just get crushed, they were erased, leaving the smart money free to stack coins at fire sale prices. The ETH accumulation zones are what really tell the story. In Asia, cold wallets are quietly taking in coins that used to be traded freely on exchanges. Retail might think that selling into the dip is just another day, but every $2.2 billion ETH liquidation has a buyer hiding in the shadows. Mega whales and OTC desks are buying hundreds of thousands of coins without making a mark on public charts. Now put the pieces together on leverage. Paper derivatives are the most important things on the battlefield. The real supply of ETH and BTC is going down, and margin calls are coming in from all over the world. Over the Asia-US overlap, $2.5 billion in liquidations happened. Retail traders were margin called into oblivion, while institutions watched and got ready to pounce. The mechanics are simple but cruel. Low liquidity and high leverage equal retail blood in the water. BlackRock and JP Morgan weren't late to the party. They were already in place before the cascade started, with ETF flows showing tactical accumulation that perfectly matched retail panic. Asian OTC deals took all the supply off of public exchanges, allowing whales to buy without raising the price. This is a classic bait and switch. Retail thought they were selling to safety, but institutions were buying a lot of cheap coins at liquidation prices. Check out the ETH liquidation numbers. $2.2 billion was lost, with 44% of that coming from ETH alone. This shows that too much retail exposure made the market weak and the smart money took advantage of it. BTC, though not as dramatic, followed the same pattern. Panic selling in the West led to buying in Asia. This cycle is cyclical, predictable and planned, but you won't see it in the news. Do you remember when FTX went down, the 2020 DeFi liquidation waves, or the global leverage squeezes of 2008? When panic sets in, forced liquidation happens, smart money buys, and then the price slowly stabilizes, leaving the retail crowd holding the bag. The pattern keeps happening because people are always afraid and greedy. The mechanics are cruelly beautiful. Exchanges bleed. Thin liquidity makes retail mistakes worse, and institutions quietly stack while the world panics. Every margin call, every liquidation cascade, and every retail exit gives you more power for the next accumulation phase. The Asia versus US dynamic adds another layer. The West yells at red charts and tweets fear, but the East quietly stores up BTC and ETH. OTC flows, cold wallet accumulation, and exchange withdrawals all point to a secret geopolitical strategy. Asia takes in the panic dumps, leaving the US market looking chaotic while real positioning happens behind the scenes. Price charts don't tell the whole story about supply. It's in exchanges that are running out of money, in cold wallets full of coins, and in over-the-counter trades that no one keeps track of. Retail thinks the market is crashing, but institutions know they're seeing a once-in-a-cycle chance to buy something at a lower price. And here's your cliffhanger. It doesn't end there. The East quietly buys up BTC and ETH while the West panics. Part 3 shows how central banks, whales, and regulators are quietly setting the next trap in the geopolitical tug-of-war that is heating up behind the scenes. The next move could determine which side has the most power over the global crypto supply. Part 2 showed the bloodbath on the exchange, but the real story is happening in geopolitics and stealth accumulation. After the US liquidation panic, ETF inflows into Hong Kong and other major Asian exchanges shot up. This is the kind of flood that no headline talks about. On-chain data shows whales moving coins to cold wallets across Asia without making a sound, stacking BTC and ETH in almost complete silence. Traders in the West are still freaking out, not knowing that Asia is quietly buying up supplies at rock-bottom prices. The size of this is mind-boggling. Asian centralized exchanges now handle almost $3 trillion every day, which is much more than the US ETF liquidity is close to $120 billion. That's a difference of 25 times, which means that the West's panic doesn't really affect the real accumulation going on in the East. Every forced liquidation in the US gives Asian institutions more power, quietly helping them build up their assets, while retail investors think the market is crazy. Now put the pieces together for buyers. Not just whales are taking these coins. Central banks and hidden wallets are too. Big OTC deals skip exchanges altogether, so regular people don't know that a big change is happening. Coins that disappear from margin calls in the West aren't gone. They're being strategically stored in other countries, making them harder to find in public markets. In this chess game, policy is the quiet weapon. Uncertainty about US regulations and stricter scrutiny of ETFs make the market more volatile and keep retail investors scared. At the same time, Asia is loosening its rules on cryptocurrencies, creating hidden paths for accumulation. The West thinks it controls prices, but the East quietly decides who will control supply chains in the future. Supply itself is becoming a war zone. The difficulty of mining BTC has been going up, which means fewer new coins are being made. On the other hand, ETH staking takes away liquid supply by locking coins away for months or years. Every coin that was lost in the US liquidation wave goes straight back into the hands of institutions, which gives the East more control over the market. Retail is still stuck in panic cycles, but Asia is slowly taking in and locking up supply. This isn't just about the prices of cryptocurrencies, it's about the system. BTC and ETH are now competing with the US dollar for cross-border payments. Asian and Middle Eastern central banks are buying more of these coins, which makes them more important to the system. This means that every liquidation, every OTC transfer, and every cold wallet accumulation changes the balance of global financial power. What seemed like a local crypto panic is really a shift in wealth and power on a global scale. And the human element makes the story even more interesting. Retail panic keeps the machine going. Margin-called accounts, forced liquidations, and frantic selling are all things that help Asia's stealth accumulation. There is a perfect storm of supply shortages, regulatory gaps, and liquidity misalignment. At the same time, traders in the West are still trying to make up for their losses, not knowing that the coins they sell are already safe in strong Asian vaults. The lesson is hard. The $756 million loss wasn't just a market event, it was a planned attack. Every chart, every margin call, and every panic tweet is a piece of a bigger puzzle. Retail sees blood in the streets, but institutions are quietly building a long-term fortress of assets. Asia is winning the silent accumulation war. And here's the cliffhanger. All of this leads to an unavoidable conclusion. The global economy is about to feel the effects of this 756 million liquidation. Part 4 shows how debt, inflation, and systemic weakness are connected and why the next move could cause chaos that goes beyond crypto. Part 3 showed that the East was quietly taking in every liquidated coin. Now, the macro storm is ready to hit. The bond and debt crisis is happening at the same time as crypto's liquidation, and the system's flaws are clear. The national debt of the United States is close to $38 trillion. Bond yields in Japan are rising sharply, and global leverage is on the verge of collapse. Every forced liquidation, margin call, and panic sale in crypto shows how weak the system is. The $756 million wipeout is just the tip of the iceberg. The Fed doesn't have many cards left, though. Inflation is still high, economic growth is weak, and short-term cash injections may calm the markets for a day or two, but the risk goes through the roof in the long term. The printing presses can't fix structural weakness. They can only put it off for a while. In the meantime, exchanges are running out of money, derivatives are dangerously leveraged, and retail is stuck on the wrong side of every squeeze. The system is set up to help big whales and institutional players, while retail has to deal with the damage. Now put the pieces together. The $478 million in BTC long liquidations and $520 million in ETH long wipeouts are not strange. They are warning shots. Retail gets margin called, small accounts are wiped out, and panic grows. Whales quietly gather supplies in preparation for the next planned squeeze. If retail rebuilds leverage, another cascade will happen. Not every crash is random. They are planned to take money from weak hands and give it to a small group of powerful people. This planned tension is shown in price predictions. BTC looks like it will test the $65,000 support level again, and ETH looks like it will go to 1950. These aren't guesses. They're the lowest prices that institutions are willing to defend while retail panic gives them cover to buy more. Another violent swing is about to happen, and only those who can control their keys will live. Here's the human factor. Millions of retail traders are still connected to exchanges, thinking they can time the market, while institutions set up traps. Every time a whale sells off in a panic, it makes their strategic position stronger. Every time a retail trader makes a mistake, it adds to systemic risk. The market isn't just unstable anymore. It's set up to have bloodbaths over and over again. And here's the call to action. Get out of banks. This is about more than money. It's about staying alive. Now is the time to take care of yourself. Don't let the system catch you next. To stay ahead of the next planned crash, hit subscribe and like. You need to be in charge of your keys, your money, and your future. Only owning something will protect you from the next wave. Watching prices on a screen won't help. Freedom isn't watching prices on your screen. It's controlling your own keys, assets, and future. The cycle of planned panic, leveraged destruction, and institutional accumulation is far from over. Asia's quiet growth, the fight for liquidity between East and West, and the economy's overall weakness will shape the next few months. Headlines can't save retail. Only keeping an eye on your own stuff and being careful can keep you in the game, while the system keeps taking what it wants. Don't get stuck like retail. Take control now. Get out of banks, keep your own keys, and own your assets. Hit subscribe and smash like to stay ahead of the next engineered crypto crash before it wipes out another 756 estimators.